Hello and welcome to episode 7 of the Talking Central Banks podcast with me, Karan Merishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about liquidity in the Indian monetary system, especially in the money market segment. Our guest today is Gurumurthy R, who is a former regional director of the Reserve Bank of India. As a central banker, he worked extensively in the areas of government debt management, foreign exchange reserve management, financial stability, and financial markets operations. He was the chief dealer managing debt and forex, that is, rupee dollar desk, which is part of forex reserve management and all market operations of the Reserve Bank of India. Between 2017 and 20, he was a member from India on the Analytical Group on Vulnerabilities under the aegis of the Financial Stability Board, or FSB, Switzerland. He was also a member of the FSB peer review group that peer reviewed Argentina in 2016. Between 06 and 11, Gurumurthy went on a sabbatical to work with currency market specialist and former vice minister of the government of Japan, Eisuke Sakakibara, who was nicknamed Mr. Yen. He is an alumni of the Wharton School and received his MSc in Global Central Banking and Financial Regulations from the Warwick Business School. Welcome to the show, Guru.
Hi, Karan. Greetings. Pleasure to be on your show.
Thank you very much. My pleasure to have you. Starting with the RBI's 25 Internal Working Group on Liquidity Management Framework Group, it has recommended to continue with the weighted average call money rate as the key operating target for the conduct of monetary policy. The question is, how effective is the WACR as a barometer for liquidity targeting in the Indian monetary system?
Okay, Karan, fair to be the working group. It begins by acknowledging the elephant in the room. Weighted average call money rates relevance is diminishing. The call money market, which weighted average call money rate reflects, now constitutes a mere 2% of the overnight market volume, down from 16% in 2010 and 11. Despite that, the report argues WACR gives a tighter control since only banks and primary dealers directly under its ambit participate. But this is a circular logic. Narrow the field to only those you regulate, then claim precision because others are excluded. The real issue is when we deal with systemic liquidity, the system is not banks alone, at least no more.
Right.
Especially as the chair of the FSDC subcommittee, RBI should assume a mandate much larger than that when it comes to the definition of systemic liquidity, which means it has to go beyond banks.
Right.
I'll come to this argument later in the context of enhanced mandates, explicit or implicit, of central banks post-global financial crisis. Collateralized segments where mutual funds, insurers, and pensions dominate, they account for over 90% of overnight volumes. To dismiss them as the operating target because they're harder to regulate is like ignoring India's vast informal economy in employment data.
Guru, in a recent article, you described this continuation as defending tradition with fine print and a lot of sweat. I'm sorry.
Yeah,
What makes you say this?
Yeah, as the report itself suggests, RBI has the maximum leverage on weighted average call rate.
Right.
Let me take you to paragraph 1.3 of the executive summary of the report. It says, the uncollateralized rate better reflects credit counterparty risk that's not masked by collateral, right?
Right.
For me, this precisely should have been the argument against using uncollateralized rate rather than using it, because liquidity stance through any interest rate mechanism can be overwhelmed by counterparty risk in times of crisis.
Right.
The global movement to move to SOFR is precisely for this reason.
Okay.
Then look at 1.4 paragraph of the same executive summary, which says, WACR is also found to be effective in transmitting signals to other market rates like treasury bills, commercial papers, certificates of deposit, and government securities, etc.
Okay.
Let's see whether this is working through the following example of F-bills September 9th data, which you can project on the screen later. On the T-bill yield curve, it's all over and inverted. Look at the kings. Let me read it out actually. So it says at 5:30 p.m. on 9th September, it gives the rates. 7 days 5.57, 14 days 5.53, 1 month 5.45, 2 months 5.46, 3 months 5.47, 4 months 5.5. Like that, it's all over. So according to me, central banks should be at the top of the short-term yield curve management, isn't it? Even if that argument is that the report is true, in the case of CPs and CDs, the marginal, possibly the major investors are mutual funds, for whom the effective overnight rate is collateralized. So if one wishes to influence uncollateralized term rates for the real economy, they're better off targeting overnight collateralized rates. That's my argument.
The working group also recommended the replacing of the 14-day variable rate repo and reverse repo auctions within the liquidity management framework, or the LMF as we call it. I think it was an experiment that shows us that monetary system is actually in ex-ante deficit most times. Given that commercial banks were unwilling to part with their short-term liquidity for such a long duration within the framework. I reckon even the 7-day auctions wouldn't be as attractive as designed by the working group. What do you think about this?
Of course, there's a merit in keeping the system ex-ante deficit in certain contexts for policy signal to transmit better. But that's not etched into 10 commandments, right?
Right.
Even if that's true, in a certain context, that doesn't mean that the system should be tactically kept in such deficit position through sucking up liquidity for longer durations than overnight, say 7 or 14 days in our case. As you rightly said, it would be difficult for banks on all occasions to commit funds for longer duration unless there is a durable surplus.
Right.
It's a different matter whether government cash balances are predictable for such tenors. Coming to the argument why term liquidity injection absorption is fraught with risk, I would argue that any term liquidity absorption injection will have to crystallize two things. First, the quantum, and second, the rate. Convergence of regulatory view and participant view is fraught with issues. It's very difficult to get this right. And getting it wrong has the potential to significantly distort the short to medium term of the money market curve. Hence, it's preferable to keep the central bank liquidity intervention overnight. Period.
Even if I accept that argument, Guru, then why is the working group doing away with the variability in the auctions for transient liquidity management, as RBI likes to call it, in favor of a more fixed rate 7-day auction, in your opinion? I mean, the point being, Guru, that this will unnecessarily hinder real-time transmission of rates based on liquidity conditions, in my opinion, in the call money market. Exactly. I mean, I want to have your opinion on that.
So look, the obvious shift from variable rate to fixed rate 7-day repos for transient liquidity aims, at least it seems to me, to anchor expectations, reinforce the policy corridor, and reduce noise from volatile short-term liquidity. However, in India's context of poor liquidity forecasting and unpredictable government cash balances, this approach risks misaligning policy with market realities. By muting the call market's ability to reflect real-time funding pressures, it prioritizes predictability over responsiveness. The framework may improve signaling discipline, but could force flip-flops in RBI intervention, making liquidity management more administratively driven and less market-oriented, which is an uneasy trade-off in a system prone to fiscal-driven shocks. Hence, I agree with your argument that it has to be overnight and not term, but relying again on call is where my discomfort lies. Strangely, RBI's term intervention is subject to cap of overnight repo rate, as it seems. Hope you're getting what I'm saying, which means that any other operations during the term curve, it apparently gives a feeling that the RBI is conditioned by that overnight rate. For example, the most recent variable term reverse repo rate of 8 days on September 4th had a cutoff of 5.49. I've already shown the Fibble chart that on 9th September, term rates were comfortably above that. Right? You have term interventions and then tie yourself up with all these caps and floors is unlikely to reflect the marginal cost of funds or the tenor of the repo as far as the market is concerned. Period.
So, Urjit Patel Expert Committee had recommended a contraction of the LAF corridor to 100 bips in 2016. And later, the RBI statement of development and regulation policies recommended a further contraction to 50 bips in 2017. It was argued, Guru, that this was done to better align the WACR with the repo rate and to aid better transmission of overnight call money market. I think this narrowing of the corridor hasn't really helped much because of what we call one-sided participant accumulation still occurring in the system. Thanks to large commercial banks, as you know, who are unwilling to share their CASA spoils with the rest of the system. We always see the smaller banks scramble at the MSF window, for example. What are your comments on this?
Karan, the narrowing of LAF corridor was meant to improve monetary transmission by keeping the weighted average call rate tightly aligned with the repo, thereby reducing volatility in the call market. But structural frictions remain. Handful of large banks, as you say, with dominant CASA deposits, continue to hoard liquidity, preferring to park surpluses with the RBI rather than lend it in the interbank market.
Exactly.
Quite rational on their part. Of course, they're in business. This one-sided behavior weakens an intended effect of corridor compression because transmission depends less on corridor width than on participants' willingness to trade. In India's oligopolistic banking structure, micro incentives matter more than finely calibrated corridor design. Okay. But there is also an argument that overnight rates also become more predictable with a narrower operating corridor, simultaneously leading to a smoother term curve. That's what we hope for. In a regime where rate increment is in 25 basis points parcel, should repo SDF corridor be wider than that is the question. Why? Because any liquidity swing can simply do away with the supposed policy rate movement and it goes to the top of the corridor and stays there. Would that is desirable through rate tweaks? That is a question that we have to look into.
Generally, that doesn't really happen, Guru, isn't it? I mean, invariably, as we were discussing earlier, the WACR is actually somewhere near the MSF rate because the system usually is in ex-ante deficit. So how do you solve this problem? I mean, I understand, as you mentioned, it's an oligopolistic system, but how do you solve this problem realistically?
Yeah, in one sentence, I can say that, you have to enhance the participation, but that will come to the detail in later discussions.
Right.
You may be right to note that the quarter end GST effect has been overstated as an explanation. The persistent tendency of the weighted average call rate to hover near or even breach the MSF is less about episodic fiscal drawdowns, according to me, and more about structural liquidity asymmetries. See, there are two things I want to distinguish here. The issue here is that we have to clearly distinguish between structural liquidity issues and structural liquidity asymmetries. Okay? These asymmetries are structural, not the structural liquidity per se. Then we have these large banks flush with CASA, prefer parking surplus with RBI, while smaller institutions face chronic funding shortages, as you say, and must borrow at punitive rates.
Exactly.
This segmentation means the call market doesn't clear smoothly, regardless of fiscal calendar events, right? Borrowing
Right.
programs, then you don't know when the government is going to spend or know when the
Mm.
government is going to get revenues.
Mm.
The schedules are really all over. The pattern
Mm.
is perennial because it reflects deep interbank frictions and concentration of liquidity, not transient tax or settlement cycles alone.
Right. So, Guru, we'll discuss about this more in detail in later questions. But if we go to the lower bound, that is the SDF rate, apart from the enforced excess liquidity events such as post demonetization in 2016 and the COVID era of 2021, the WACR seems to be close to MSF, as I was mentioning earlier, and
Yes.
oftentimes even exceeds that on a weekly basis.
Mm-hmm.
There was one excuse used often
Mm-hmm.
by both the RBI and market participants that with
Mm-hmm.
the advent of the GST, quarter-end liquidity drawdowns push the WACR upwards in the
Mm-hmm.
upper direction in the LAF corridor.
Mm-hmm.
But if I tell you from the perspective of my own analysis, it seems that WACR movement is actually agnostic to such drawdown events
Mm-hmm.
and seems to be perennial, as you were also alluding to earlier.
Mm-hmm.
What are your comments on this? I mean, you can also talk about the SDF and the lower bound, but in terms of the upper bound, that is MSF, what is your
Mm-hmm.
argument based on this question?
Mm-hmm. Okay, that's a sharp connection.
Hmm.
The persistent WACR MSF closeness signals that smaller banks, short on liquidity, are effectively locked out of,
Right.
meaningful interbank access and must rely on the RBI's marginal window.
Hmm.
This structural imbalance explains why the 14-day VRR auction, designed to absorb surplus liquidity, often fail. As I said earlier, the surplus might be concentrated with a few large banks who prefer the safety of RBI or redistributing to peers.
Right.
Rationing also ensures better rates, isn't it, for them? If they dump all the liquidity, all the surplus liquidity, rates will crash.
Hmm.
So banks, from their own perspective, from their own business proposition, would like to
Hmm.
ration. And
Right.
at the end of the day, anyhow, they have this advantage of placing everything with Reserve Bank of India, and the rate is not bad. Meanwhile, the deficit side of the system is forced into MSF. In other words,
Hmm.
market segmentation and asymmetric bargaining power render the corridor design less effective, with
Hmm.
RBI itself becoming the intermediary, instead of the market intermediating between itself. But more broadly, having rates close to MSF possibly also signal that the repo rate cut was effectively a political gesture, not a monetary policy move,
Hmm.
as some people feel. While it might be what was intended, I think such outcomes dent central bank's credibility.
So, invariably, Guru, one can argue that the alignment of WACR and repo cannot be realistically achieved in normal operation times.
Possibly
Hmm.
you can, but that's where I think, the tweaking of the entire corridor system. See, again, when we talk about liquidity should complement the rate decisions.
Right.
But often we tend to get into a mode where, we are neither here nor there. And there's a lot of confusion as to whether we are managing liquidity or whether we are managing rate,
Hmm.
because controlling both would be impossible and not ideal. So we
So
can
it,
discuss
yeah.
further probably, what
Hmm.
best can be done.
Hmm.
Let's see.
If I come back to the argument of smaller banks not able to access liquidity from the bigger banks, uh, then I can connect the dots with the WACR near the MSF, that is ex ante deficit, and the failure of the 14-day variable reverse repo rate auctions here. So what that means is that even though banks have liquidity, they do not want to part with that liquidity in normal operations because they are unsure of liquidity events. And the smaller banks would then continue to scramble because they might or might not get liquidity in the overnight segment. So do you agree with this?
Yes, yes, yes. I agree with that. The breaching has its own reasons beyond what's happening within these discussions that we already have had. That's, as I initially mentioned, that the liquidity goes beyond the banking system. So there are participants who will have surplus liquidity at the end of the day. So where will they go?
Right.
So that really is the question why the lower bound sometimes is not really unbreachable. Right?
So, staying with the lower bound, Guru, what are the benefits of replacing the reverse repo rate with the SDF? I mean, I understand collateral constraints during COVID forced the RBI to go in this direction. But is that really a solution to absorb unlimited liquidity liquidity events at any time? And why aren't commercial banks more open to park excess liquidity elsewhere apart from parking it with the RBI overnight?
Okay, as you rightly said, standing deposit facility replace the reverse repo. Why? As the lower bound of the corridor mainly to overcome collateral constraints.
Correct.
Unlike reverse repos, it doesn't require the RBI to provide securities in exchange, which means but this allows the RBI to absorb unlimited liquidity, an essential tool during COVID when surplus balances ballooned. The benefit is clear. It strengthens the RBI's operational flexibility and ensures that monetary policy signaling isn't disrupted by technical collateral shortages, and also that there is a floor to overnight rates among regulated entities. So regulated entities, quote unquote, that's the issue. But it isn't a complete story. Banks still prefer the RBI over market alternatives because the SDF is risk-free, remunerative, and administratively simple. A lot of flexibility it gives to them. Indian money markets remain shallow with limited depth in repo, CP, or term instruments for large-scale absorption. More importantly, regulatory incentives and risk aversion discourage banks from parking liquidity elsewhere. So, while the SDF addresses the plumbing constraint, it doesn't by itself create a culture of interbank redistribution or development of alternative safe assets. So there is a criticism that possibly the RBI's very market-making mechanism or intermediation is stalling the market structure or market mechanism to do this entire operation amongst themselves.
So you talk both about ex ante surplus and ex ante deficit, Guru. During, I mean, I understand that the LAF corridor is not able to truly represent the true picture of liquidity in the system. But in times of ex ante and exposed excess liquidity, both reverse repo earlier and now the SDF rates have been breached by the downward WACR as well. And the formers have been unsuccessful in being effective lower bounds of the LAF in times of excess liquidity. So I often wonder what is the remedy for this problem? I mean, since the WACR is breaching both the upper bound and the lower bound on a perennial basis.
Okay, the persistent breach of the corridor flow, as you all know, shows that India's liquidity framework is undermined by structural frictions, possibly due to unpredictable spending patterns of the government. That's one reason. Once again, I bring your attention to the large banks versus small banks, surplus versus deficit.
Right.
Non-banks lacking SDF access must route surpluses through banks or collateralized markets, often at sub-floor returns. So that is where the lower bound in the overall context of liquidity management of the system reflects. Okay, that is where you see why in the systemic perspective, the lower bound of the corridor is breached. This segmentation means the weighted average call rate reflects bargaining asymmetries rather than the intended policy flow. Remedy lies less in corridor tinkering and more in structural reforms, like deepen interbank and collateralized markets, incentivize surplus banks to redistribute, broaden safe avenues for non-banks, and improve RBA's liquidity forecasting. Only then can the floor act as a true lower bound rather than a notional reference.
So why can't the lower bound, Guru, be a cutoff rate? That is, whenever the WACR is breaching the lower bound by a certain BIP, then the RBI may mandate the commercial banks to lend among themselves instead of parking the liquidity with it. And that would sort of, solve the problem of aligning the WACR with the repo rate. Because if the RBI itself allows the lower bound to be breached on a perennial basis, then the market basically has no disincentive to not park or to park rather its liquidity with the RBI.
Karan, let's be clear about one thing here, that we are only looking at banks actually. So with the introduction of SDF, you hardly get to see that the lower bound is breaching. But that is only considering the banking system. What I'm talking is go beyond the banking system. What about the rest of the system? How are they able to place funds at this particular rate and not go below this? They have their own vulnerabilities because they don't have access. Ultimately, they have to go somewhere. They have to put that money somewhere. The RBI access is not available. So when you look at the system, somewhere somebody may be lending and borrowing below that floor. That's the point I'm making. But for official purposes, when you look at the corridor, one can say that it doesn't breach normally, not considering all these non-bank participants, right?
Okay. Coming to regulations, given the post-GFC regulatory push and development of markets, do you think India's monetary policy framework has adequately adapted to the structural shifts? Or is it still too bank-centric in its design and transmission assumptions? And this question sort of relates to what you were just pointing out.
Yes. Okay, I'd like to take a bit longer to answer this question as I feel this is very important.
Right.
Let's look at the changing nature of the banking industry post-global financial crisis. With Basel capital adequacy and liquidity norms, the traditional role of banks, which is maturity transformation, had to be rebooted. It was impaired in a sense, in the traditional sense. Banking business has become more suitable for a moving business than a storage business. Getting my point? The thing was, in the traditional sense, banks used to get money from the depositors and lend to somebody. And it's a slow moving kind of a business. Rather, it's a storage kind of a business. Now, world over, in the developed markets, the model has changed. Now it's originating loans to distribute. So, I mean, origination and distribution as a compatible business model compared to lending and collecting. For this transformation, you need enabling and complementary changes in the markets. What are they? Bond markets, the derivatives markets, for a seamless transition between credit and bond markets so that long-term credit needs are taken care of. Because once you have these liquidity norms and the traditional maturity transformation is impaired, how can you elongate the maturity profile of short-term deposits to lend it to the long-term players? The only way is through derivatives markets. Then came the mutual fund industries, maturity and expansion. with traditional bank deposits becoming less attractive thanks to the taxation on interest income. In search of reasonable returns, especially in a country where social security is an issue, savers move to mutual funds, say SIPs, with banks providing the requisite payment conduit. We often get to see this controversial debate like, money is moving out of banks to mutual funds, which is not correct. Only thing is the capacity for the banks to hold that money for a longer term is impaired. That's it. Ultimately, money has to remain with some bank. Mutual funds cannot hold the money. They're only mixed. Okay. It's in this context, one has to view the role of monetary policy. Like what we have in banking called law and practice of banking, we silently witness the evolution of law and practice of monetary policy. I mean, its focus, de jure and de facto. Who are the monetary policy authorities talking to? Is RBS monetary policy primarily about the credit market at all? Or is it more about managing the government's borrowing costs, keeping bond yield stream, and stabilizing asset prices? No wonder the words financial stability continuously resonates the monetary policy discourse. So we are indicating towards the stability of asset prices and the borrowing costs beyond price stability. This explains why RBI spends more time on operation twists, liquidity windows, yield management than on pushing banks for cleaner credit transmission. Right? The bond market vigilance are the real audience of every monetary policy statement. Let me make this a statement. At the same time, equity and property markets have become silent partners in this dance. Rate cuts spark rallies on Dalal Street, with valuations climbing as discount rates fall. Property developers cheer softer mortgage rates, even if the benefit is very marginal because it props up sentiment and transactions. Asset price stability, whether through stock indices or housing valuations, has become another silent mandate of monetary policy. Not to say that is not important, but what about the credit markets? While external benchmarking is fine, why repo rate should be the only external benchmark being promoted beats me. I don't understand. Banks mostly borrow term, so clearly term-based market benchmarks most suit banks' ALM. But this bank-specific MCLR, let me emphasize bank-specific MCLR, which means that each bank has its own MCLR. And again, there are so many variants of MCLR, term MCLR, corporate MCLR. So this bank-specific MCLR-based borrowing is neither here nor there. It's a regulatory creation and banks have enough scope to pad up costs. I read a speech of Mr. Vogel delivered in 2011, probably, I think, R.K. Talwar Memorial Lecture, where he bemoaned the lack of liquidity of loans. How can you have liquidity of loans tied to bank-specific MCLR? There's no common rate, right? Trade in that. Also, how can a system be almost 100% on floating rate regime so far as loans are concerned? That's what is practically happening, actually. If you go to a bank, they'll offer both fixed and floating for mortgage loans, say, for example. But if you look at the fixed rate, they're way above, which means that they want to cover all their possible risks. They don't offer really competitive fixed rates compared to floating rates. So you are forced to go for floating. That's the mechanism through which the system operates now. Managing interest rate risk in banking books specifically means that banks manage the interest rate risk of fixed rate long-term loans with typically shorter maturity deposits. In our regime, the entire risk of interest rate is borne by the borrowers so far as loans are concerned. So I think post GFC, the very models of banking across the world has changed. Have we? So that is the question. And there's a lot of scope for that. We kept on talking about, developing bond markets, like, for the last, 25, 30 years. But we can move a bit. We can show volumes, but in terms of depth and, versatility and, utility, of converting loans or, into bonds and vice versa, I think, we have to go a long way.
So based on this analysis, Guru, I'm actually coming back to square one.
Mhm.
Because if you're talking about monetary policy management through the credit uh, channel, then
Mhm.
that would mean that even the monetary policy itself is tied to the system being oligopolistic, as you're mentioning, because even
Mhm.
the FALCA,
Mhm.
which a portion of which is then used for accessing the MSF, for example.
Mhm. Mhm.
Even that is tied to what the rates would be
Mhm.
in the government debt segment, for example.
Mhm.
So unless and until we do not have a deeper uh, bond market, the
Mhm.
credit channel itself will be held hostage
Mhm.
to the system being overwhelmingly driven by government debt.
Yes, absolutely. 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 We used to talk, I think, at least 25 years ago about crowding out. But,
Mm,
that still happens, I believe. And, given the way banks operate and given the apprehensions about, bad loans and, accountability, all kinds of things, uh, if I were to be a banker and given a choice, I'd prefer to put my money in government bonds and,
mm,
make money through that differential interest rates, possibly.
mm.
And if I'm
Correct.
forced to give loans and, I have to cover my costs to the extent that, because there are lots of, cross subsidization given the priority sector advances and, given the default rates. So somewhere I have to make up my money. Then I load all those things into my MCLR for corporate
Mm.
lending.
Right.
So that actually segments the entire market in terms of uniformity, lack of uniformity,
Mm,
whatever it is.
mm,
So yes, I agree with you that we are hostages in a way.
mm,
But then these are all the things possibly that we have to do. Like how do we deepen the bond markets? Uh, Mere speeches won't make things happen. But
mm,
somewhere somebody has to see. Sometimes somewhere I have written that by not taking risk we are taking risk. That's
mm.
kind of scenario probably we have to overcome.
And not deepening the market in the process.
Yeah, yeah.
So, given India's evolving financial markets, Guru, do
Hmm.
you see the liquidity framework converging more with the realities? And how do you view the communication challenge for the RBI in balancing rate signals with liquidity actions without actually sending mixed signals to the market?
Another interesting question. Historically, the lender of last resort rule was about funding liquidity,
Right.
ensuring solvent institutions don't collapse due to temporary mismatches.
Mm,
The global financial crisis revealed that distress was not about funding alone,
mm,
but about market liquidity evaporating.
mm,
When even high quality assets like AAA MBS couldn't be sold except at fire sale prices. This forced central banks to invent facilities like the Fed's TALF, QE programs, and standing
mm,
repo facilities, which were
mm,
as much about stabilizing market liquidity as about funding banks.
mm,
The boundary between funding and market liquidity, therefore, blurred. A bank that cannot liquidate assets in stressed markets faces a funding crisis, and conversely, a funding squeeze leads to market fire sales.
right.
At a higher level, central bank's overriding concern has shifted from just price stability, that is inflation targeting, to systemic stability, which I have
Mm,
already mentioned. That means preventing asset price crashes and vicious spirals where illiquidity morphs into insolvency.
mm,
Illiquidity driven insolvency, what we call. Otherwise, there might not be any insolvency. Post GFC and again during COVID-19, central banks had to backstop both money markets and broader asset markets, as you know, like
mm,
corporate bonds, ETFs, even commercial paper. This shows how funding liquidity and market liquidity converge into a single financial stability mandate. The inflation versus stability trade-off is visible today. Central banks tightened aggressively for inflation, but kept facilities like the Fed's bank term funding program after SVB's collapse. I think it's called BTFP, Bank Term Funding Program, to ensure liquidity shocks did not trigger wider asset price collapses. The point is, yes, at the higher level of financial stability, funding and market liquidity are inseparable. Central banks today worry less about which type of liquidity is under strain and more about preventing feedback loops that could destabilize the entire system. This is where I keep on talking about the entire system, and when matters, when liquidity matters, it's about the entire system. It's not banking system alone. The inflation mandate remains, but in practice, liquidity management has become the hidden half of the modern central banking.
Talking about liquidity, it is often assumed to be a cushion when it is something more profound, as you also mentioned in your commentaries. In the Indian context, Guru, how should policymakers design liquidity frameworks and market structures to ensure resilience rather than dependence on central bank interventions? And I think even you have talked about this earlier, but maybe you can give more detail around this.
Okay. Current liquidity in financial markets is often misunderstood as simply the abundance of cash, which is not the case in reality. In reality, it is a double-edged sword. Okay, too much of liquidity is also not good. Too less of liquidity is also not good. True market liquidity comes from the diversity of products. See, normally, technically, when we speak in the textbook kind of, an understanding, we think the narrower the bid-offer spread, the more the liquidity.
Right.
When we talk about market liquidity. But people like Avinash Prasad, they say, now in the current context, post-GFC, it's not about bid-offer spread. It's about the diversity of products, the heterogeneity of market participants, and the variety of expectations they bring. Otherwise, markets become monoculture.
Okay.
When everyone rushes to the same side of the trade, liquidity can vanish just when it is most needed.
Correct.
Till the previous moment, there was so much of liquidity, and market overshoots and liquidity disappears. So it's a loop. It's a loop. As I said, this is what Avinash Prasad famously described as liquidity black holes. Black holes in physics,
Correct.
even light can't escape.
So
we get into the trap, actually. Moments when the very instruments and practices designed to provide liquidity end up amplifying its disappearance, triggering systemic stress. So this is the understanding probably that we have to have. Policymakers should, one, strive to bring diversity into markets. Alternatively, they should address policies that drive markets unidirectional. Two, shift the burden of routine liquidity management from the central bank to deeper, more transparent, and better connected markets, with clear, pre-announced, rule-based backstops only for systemic stress. Not everyone want them. There the central bank is sitting there with a bounty of cash that anytime I can go. It's also important to acknowledge that non-banks have grown in stage and need to be recognized part of the system for any meaningful liquidity management framework.
Correct. Yeah.
Why can't they be allowed on the lending side?
Exactly.
Everything need not be apprehended on the lender of last resort constraint, because we immediately go to the definitions. What do you mean by lender of last resort? Lender of last resort is lending to distressed banks against high quality collateral. Okay, so can we go beyond banks? There's a constraint. Over dependence on a thin set of participants, like what's happening in call market, magnifies volatility. A wider set of market makers, dealers, and institutional participants improves depth. When we have depth, actually, we don't have to worry about all these things. Market takes care of itself. We have to see how best we can encourage non-banks, mutual funds, pension funds, insurance companies, and larger NBFCs to operate as liquidity providers. Hence, policymakers, I think, should encourage adoption of a single overnight secured benchmark, which I've argued in my writings also, SORR, as the operative target in lieu of weighted call money rate, and align standing facilities to that benchmark so that market signals are clear, along with encouraging markets to move towards a few critical market-based term benchmarks. Otherwise, either they expect RBI to be everywhere, or RBI takes initiative to be everywhere.
So China apparently has a interbank bond market. It's called a CIBM. And it is actually worth about 20. So the trades on that platform are roughly close to actually more than $15 trillion. Why can't, Guru, we have a similar marketplace in India where all market participants are part of a marketplace, a common marketplace where they can, trade liquidity and fixed income instruments? For example, it might solve a lot of problems for liquidity for smaller commercial banks, NBFCs, insurance companies, as you were mentioning earlier.
But why is it not happening? Because there are constraints actually, whether it is, because of regulation or because of, what should I say, the comfort that I'm already getting through the existing, a market structure that I can, place with this, place with that without taking risk. So where is the push for me? Where is incentive for me? Where is, necessity or need for me to get into that kind of a mood actually? So for that, the push has to become a shove. So which is not happening actually. Which is not
there is the incentive. So there's an incentive to deepen the market, as we were discussing earlier. Because if we have a common marketplace, then basically the market takes care of itself. Because then liquidity finds its way where it's most needed.
Right.
And that is the basic principle in liquidity management.
Right.
But if you do not allow all the participants to be on the same platform, then we are basically excluding the parties which most require liquidity.
Exactly. That is my point also. That, somehow, the regulatory prescription has to look into these, shortcomings as of now. And, seriously work together across regulatory agencies to make it happen. Oftentimes, it is, one regulatory agency versus other regulatory agency who controls what, principle-based versus, product-based kind of regulation. All kinds of things are there. See, like, if you look at the UK, if it is about prudential regulation, every institution comes under that. We have, separate regulator for insurance, separate regulator for securities market, separate regulator for banks and non-banks. So the turfs, basically, turfs. And the most important thing is that, we have to shake up this inertia that, that's what, often I say that, by not taking risks, we are taking a lot of risk. That, if you have to be, the best of the markets. And we often talk about, we have to have 3 to 4 global sized efficient banks. But, size alone doesn't give you strength. It's a versatility. It's a skill sets. It's operation,
so we'll have the same problem.
Governance, all kinds of things.
If we have the bigger banks, then we'll have the same problem, isn't it? I mean, then there'll still be a one-sided system where these larger commercial banks, even larger, if we have them, will hoard the liquidity. And then again, the system remains ex-ante deficit because it has no access to liquidity.
Yeah. Let us, look beyond liquidity. Actually, what happens is that, if we really push them to consolidate and become huge elephants without, structural reforms, what happens is, we are unintentionally creating a lot of, too big to fail institutions, and in a way, also encouraging moral hazard.
Turning our attention to alternative collaterals, Guru,
Hmm.
the RBI holds just around 1% of corporate debt on its balance sheet, while Indian commercial banks hold around 20% of it.
Mhm.
Yet commercial banks are largely disqualified to use such assets as collateral under the LAF corridor. As a remedy, do you think the RBI must hold more such securities in order to deepen the penetration of corporate debt in the LMF or the liquidity management framework and diversify collaterals in the system, in your opinion?
The broad answer is no. Okay, when I come to the details, let's separate the grand theme of development of corporate bond markets and the current context. We always
Hmm.
talk about, we mix up things actually, Expecting RBI to weaken its collateral standards for market development is like asking the army to fight with toy guns to encourage the local arms fair,
Hmm.
right? Some sanctity should be maintained, when it comes to the nature of lender of last resort. Central bank's core function is to provide liquidity and maintain monetary and financial stability, not to allocate credit. According to me, I don't know how others view this. Hence, it should avoid taking on private credit risk under normal circumstances. Sovereign bonds are the safest asset in domestic currency since governments can tax or issue more currency. Holding
Right.
such paper preserves the integrity of the central bank's balance sheet. If it held risky assets, losses could undermine confidence in both the institution and the currency. Of course, one might argue that the kind of things that's happening across the world, including the way Fed is being treated. In any case, we are undermining the confidence in central banks. But money created by the central bank is effectively backed by the quality of its assets.
Hmm.
Sovereign bonds also provide deep, liquid markets that allow smooth monetary operations.
Right.
Corporate or private paper is illiquid and can cause market distortions if the central bank trades in them.
Hmm.
During crisis, exceptions are made, of course. Central bank may temporarily hold risky paper to unfreeze the markets. Like, when we are talking about the overall, serious liquidity shortages, whether it is market liquidity or, funding liquidity. You can do, abnormal times, abnormal solutions. But once stability is restored, even if they do such things, once stability is restored, it must return to sovereign assets to preserve credibility and neutrality. To the best of my knowledge, RBI has never conducted repo operations directly against corporate bonds. Hence, the 1% holding of corporate bonds by RBI that you are talking about, if any, might be due to other reasons. I haven't checked that. Okay, for some
Right.
other reason, they would have probably, some multilateral institution, whatever it is, I don't know. The closest it came was TLTRO, that is in 2020, which routed liquidity into corporate bonds indirectly while keeping G6 as repo collateral with RBI. In the sense that during COVID, what happened? RBI did provide liquidity support indirectly. It launched targeted long-term repo operations, TLTROs, where banks borrowed funds from RBI against G6, but with the condition that these funds should be used or invested in corporate bonds, CPs, and NCDs. This was a way of channeling liquidity into corporate bond markets without RBI itself taking corporate bonds on its balance sheet. That's what we have come closest to holding, probably helping the corporate bond markets in terms of squeeze.
So, Guru, a question on capital structures and financial stability.
Mhm.
What are your views of the post Dodd-Frank integration of stress tests in the American Comprehensive Capital Analysis Review and it becoming a standard tool in assessing financial stability in the rest of the world, including the adoption by the RBI, percolating via BIS and the Basel mandates, as you were alluding to earlier? What are your views on its effectiveness after the 2023 failure of SVB and Credit Suisse?
Mhm. Okay, stress testing, as we all know, born in 2009 with the Fed's Supervisory Capital Assessment Program,
Hmm.
which later evolved into Dodd-Frank staple and spread globally through BIS and Basel mandates. It became both a regulatory ritual and a symbol of vigilance. Its effectiveness, however, remains contested. Initially, it really worked well. Actually, it was taken very seriously. And in some parts of the world, even now, it's not totally diluted, except that the recent stress tests conducted by the US Fed were subject to a little bit of criticism. Scenarios often simplify risks, assumptions are selective, and regulators have expanded into areas like climate while overlooking classical vulnerabilities. This risks offering more theater than assurance, according to me. For example, the 2023 failure of SVB and Credit Suisse exposed these blind spots. SVB, exempted from testing after the 2018 bill, fell to a plain vanilla interest rate shock. SVB was solvent, actually, because of interest rate shocks on its huge holdings of sovereign bonds. So it was ironically tied to Fed tightening. Credit Suisse passed Swiss and European stress tests, yet collapsed from years of mismanagement and confidence erosion.
Right.
Both showed stress tests can miss the very triggers of failure. So they have limitations. More broadly, US scenarios long downplayed rate shocks. The ECB avoids sovereign default scenarios because how they have their own problems of not having fiscal integration, only monetary policy integration kind of issues. And liquidity risk remains poorly modeled despite SVB, Credit Suisse, and the UK's LDI crisis showing liquidity, not capital, often drives collapse. Under the Basel norms, we went on, tweaking these capital adequacy rules. But, when you really face a serious liquidity or operational risk-based crisis, no amount of, capital can save you. So banks, meanwhile, game the process through balance sheet window dressing and model tweaks.
Exactly.
So
That's the argument.
In short, stress tests remain useful, but more as a regulatory signaling than as a true predictor of fragility. Without sharper scenarios, better liquidity focus, and less regulatory complacency, there is reassuring precisely when vigilance is needed most. So I won't completely rule out saying that, junk these stress tests. It's in your own interest. It's in the interest of the individual institution to know what kind of stress that they can or they are encountering and prepare themselves well. But at the same time, that should not be taken as something like, the thing to assess or address, systemic risks or, possibility of failure scenarios.
Finally, traditionally, stress tests focus on capital adequacy ratios, which we know can be manipulated. And you just alluded to that in your previous answer by financial institutions. And also, CAR does not adequately reflect real risks emanating from liquidity shortfalls on a regular basis, which have been the reason for recent bank failures, as I was pointing out, pertaining to SVB and Credit Suisse. Do you think stress tests must therefore incorporate liquidity targeting instead in order to better reflect the evolving market realities, in your opinion, Guru?
Okay, as I just mentioned, stress tests have value. The value not as predictors, but as tools that shape capital buffers, discipline governance, and force institutions to confront vulnerabilities. But yes, liquidity must move from a side note to the center of stress testing. Like, what we have seen in the case of SVB or Credit Suisse or whatever it is, UP's LDA episode, that show banks don't collapse because counting capital vanishes. They fail because cash and collateral run out before regulators or markets can react. Markets overshoot, and no liquidity buffers can address that. This is the case of typical liquidity black hole that I was mentioning. But that possibly happens once in a blue moon. That was our thinking. Things have changed. Current tests often assume funding market remains open and central bank backstops are reliable. So there is a bit of moral hazard already ingrained that whatever comes the central bank is there to help us. Good and bad. Reality is harsher. Once confidence breaks, liquidity evaporates faster than models allow. And in a digital banking and algorithmic trades, things turn out to be harsher. Think of a day when stable coins arrive and it becomes 24/7 of everything. How LOLR is going to work? No amount of liquidity can save you. Because stable coins, if they become part of the system, you can move beyond the operating hours or beyond regulations to transact. Okay. So during those periods when somebody is sleeping, things happen, things go awry. So what kind of backstop arrangement can you think of from any central bank? Capital adequacy should remain, but be complemented by scenarios that explicitly ask how long can a bank withstand deposit flight, which banks already do, like that liquidity ratio managements, LCR or the long-term funding ratios or whatever it is. What assets can be liquidated without fire sales? What if central bank support is delayed or politically or structurally constrained? Structurally constrained means, I'm talking about the scenarios that I have just envisaged. Such targeting would reflect the real-time dimension of failure. That's it.
But the argument here is, Guru, that both CAR and LCR are at the whim of economic cycles. So, I mean, my personal assessment is that the SVB crisis was directly connected with balance sheet normalization and interest rates rising in the US. And whenever such things happen, it has a direct bearing over the LCR and CAR. And then if you do not have adequate backstops for liquidity management, then no matter how much collaterals you hold, as you were also pointing out earlier, you cannot really survive that kind of a shock, no matter how many pre-shocks experiments you have conducted in the system.
True.
So are we in India prepared for such an event of this magnitude? I understand the RBI comes up with these shock analysis often, but do you really think that if a liquidity event of this magnitude happens, then would the system be able to withstand, given the fact that we have a couple of very large banks which are too big to fall and are basically, I mean, the backstop, the primary backstop is the oligopolistic system that we were talking about earlier, that is government debt, which might not default. But still, when interest rates go up, then the value of debt goes down. So how do you think this can be managed?
Yeah, these are very serious issues actually, Karan. That's why, I kept on, talking about price stability and financial stability in the same vein, in the sense that when monetary policy authorities talk about rates or liquidity, 50% of their mind is also focused on the financial stability issues, asset price issues. Unfortunately, in the SVB case, what happened was, whatever be the structure that they have, it was not under the purview of, Fed's stress testing compulsions.
Exactly.
So I was just wondering why nobody could see through that happening, actually, that possibility materializing. When somebody, see, that's where, the irony lies, actually, that, people say that now you hold sovereign assets which are completely risk-free. And suddenly because of that a bank collapses. What can you say? What can you say? See, we are fast moving into digital world.
Yeah.
We hype it up actually, and the way we are operating, and even if you say these are small transactions, the UPI is 24/7.
Right.
Okay, when this 24/7 kind of a banking comes to across all products, markets, sizes, and then if the US goes ahead. Already it's going ahead with, the promotion of stable coins. And we don't have any option but to emulate it. We also get into that. Then, there are all serious issues, how do we deal with the repercussions because of all these changes? One has to be seriously prepared. See,
Right.
when we talk about stress tests, okay, we started in a small way. We do conduct like, macro stress tests that in RBI conducts. And like, top down, bottom up is conducted by, banks, I believe. So, somewhere, we compare both and all those things. But unfortunately, what's happening is bank specific stress tests, like, in the US, what they do is, they use it for the adequacy of assessing the adequacy of capital.
Correct.
Okay, supervisory capital.
Right.
But we are not even there actually. We're not even there. And when we think of aligning banks and non-banks, the size really grows too big. And we are not as complex as the Western world is where it is as far as the banking industry is concerned. But right, these apprehensions are, they deserve a serious look at, and we have to be really prepared for it. The next battle could be something different actually. It's not that, we are going to fight the last battle. So we have to really prepare, assessing all these possible scenarios and, be prepared for it. Like, in a 24/7 digital kind of a thing, imagine a bank have any time to react.
Exactly. And that brings me to the point pertaining to LCR unpredictability, Guru. Because if you have 24/7 banking, as you were pointing out, then your 90-day outflow basically is an unpredictable variable.
Yeah.
And then you don't really know how much have a sufficiently healthy LCR. Because you don't really know what your 90-day outflow would be
No
tomorrow,
one
for
knows.
example.
No one
Yeah.
knows. No one knows.
You have to base your analysis based on forward forecast, for example, which might not be adequate or which might not really give you the exact picture of what would happen.
I feel that, all these tests are okay, but, they can tell you, what you can do at best when things, move from bad to worse. But the thing is, there is no complete, 100% foolproof solution for anything.
Exactly.
See, the next risk may be something entirely new. We may be, talking about some risk based on past experiences and, extrapolating these into something new. But we may not really know what exactly would happen in terms of if it manifests, the next risks manifest, what kind of risk it could be. To some extent, we could prepare ourselves, but are we even closer to that some extent is the real issue.
And in your assessment, what can be the backstops just to contain this unpredictability of the LCR?
I don't know. I really don't know, to be frank. But ultimately it has to be LOLR, lender of last resort. That's way. See, the moment you fine-tuned the regulatory norms through Basel framework, you have transformed everything into liquidity management and capital adequacy management. And the whole system of maturity transformation framework is broken, and without your other complementary market microstructures, macro structures, like derivatives markets, depth in bond markets, and all these kind of things, the seamless flow of stress, if any at any point of time, may be difficult to hold back actually. So we need shock absorbers at every point in the entire network. So for that, we have to create a smoother network where we can have checks and balances at every point, and there is a seamless flow of funds from one market to the other to the extent possible. And ultimately you have this, we have already created a situation where for everything, the central bank is there, with its ability to print enormous amounts of endless amounts of money. But that, should be the last resort, as the name goes.
So one final question, Guru, since you mentioned about the LOLR function of the RBI, is the LOLR limited to the MSF window, or are there any other tools or instruments in place which allows the RBI to perform that function? I mean, given the RWA and the LCR calculations, are there any other tools in place apart from the MSF?
See, let us not, probably, get into specifics in the sense that, it may turn out to be meaningless in the sense that, RBI, if it wants to create, any number of tools, it can create. But ultimately, the name is, LOLR. See, as long as I can be the lender of last resort, I can create any structure, any product that serves the purpose.
Right.
Okay. So whether you call it by any name, So I don't know what is the intention behind this question, but do you have anything specific in mind that
So I'm actually comparing the LOLR of the RBI with that of the US Fed. So US Fed has a number of LOLR tools in place. So for example, banks basically keep some of their reserves with the Fed, and in the times of need, they can access those funds, for example. Now I understand that we have a similar tool which we can call the CRR, that the banks keep as deposit with the RBI, but CRR is non-interest bearing, and it cannot be accessed by the system whenever it needs liquidity, because that's a mandate with that commercial banks have to heed. But they have no access to that once they place that 3%, 4% of the NDTL with the RBI. So unlike the Fed and a couple of other central banks across the world, the system basically has no access to the reserves it keeps as mandates with the RBI. And that is not part of the LOLR, at least officially. So I was basically wondering that apart from the MSF, which is the only comprehensible window which may perform the LOLR function, what else does the RBI has which the market can access in times of need?
That's what I'm saying, basically, depending on the complexity or the need of the situation, you can come up with any. For example, even if you talk about CRR, there is a clear thinking and indications that RBI is going to reduce the kind of reduction that they have effected in the last before that monetary policy. So it's non-remunerative, but it serves some purposes traditionally. And if you look at Bank of England, they have done away with it, the minimum kind of reserve requirements.
Exactly.
So
But they still have that, yeah.
They have done away with that. So see, it's flexible actually. It's flexible. And to the extent that the system needs these funds and there is a merit in releasing these funds, possibly why should any central bank sit on that? Right? Unremunerated kind of things. So ultimately, what I would feel is basically push the market into managing its own liquidity amongst the participants by themselves, and be a true lender of last resort, and try to manage the repo rate sanctity and the short-term curve sanctity, that like not having too many kings and downward sloping kind of a thing when it should have been upward sloping, and manage the corridor if possible, reduce the corridor so that you're forced to have a better control over it, the width of the corridor, and let markets perform a number of duties that on their behalf the central bank is doing right now. That's how I put it.
Well, that's all I have for today, Guru. I am sure this was a highly awaited segment for our audience, very informative. Thank you once again for the time.
Thanks, Karan. It was a pleasure talking to you.
Thank you so much.